We are live. We are live. Let me just still getting set up here, but we're gonna get going here in just a second. Of course, I got to be early to allow everybody to come on in, but this is going to be a great session. It's gonna be pretty cool. We're gonna get started here in about 5 minutes. Let everybody just go ahead and come in. All right, cool. All right, I am ready to go. This is gonna be exciting. So I created this YouTube channel specifically for beginners. A lot of people have asked me like, man, like there's just so much information I don't know. Can you uh can you look out for me? So of course, look out for you. So, of course I'll look out for you, right? It's just too much to know. But so we're gonna start at step one today. We're gonna start at step one and just cover some of the basic information that a lot of people, to be honest with you, they kind of overlook. They overlook, but it's some of the most important stuff, to be honest with you, that you really need to know. If you overlook some of this stuff, then me personally, I think you kind of making a mistake. But we're gonna get started here in about 2 minutes. Yeah, I see people joining. Cool. So I actually teach this course, right? This is kind of like a course that I created for some of my followers, and I taught this a few weeks ago. I've taught this several times, so uh, it's a lot of basic information, but I feel like if you know this information, you'll be well prepared and well versed in investing, and you'll be to the point where you could do your own research and make your own decisions when it comes to investing. You won't have to rely on other people anymore for advice on choosing which stocks to buy, which stocks to sell, and things of that nature. And not only that, you'll be educated to the point where soon you'll be able to educate and teach your friends and family members on how to invest as well, which is a wonderful thing, which is a great thing actually. So I'm looking forward to getting everybody to that point. But just know that the material that I'm covering, I mean, honestly, this is like it's like a 4 week course. It's about an hour and a half course per week that I usually cover. But I'm gonna cover this over maybe over 2 or 3 month period, just to go slow so people can really understand. So just know that, like I said in the beginning, a lot of people think the information we're going to cover today is boring. They just think it's boring. Like, I don't really care about that. I don't really want to know all that. But you need to know it. It's kind of like, playing a game, for the first time. You don't know all the rules. And you just in there playing, like, hey, come play this game with us. Like, all right, cool. How do you play? And you just get in there and you just start playing, but you don't really know the rules. So if you're winning, you don't know unless somebody tell you that you're winning, or if you do something good, you don't know unless somebody tell you. So you need to learn the rules before you start playing. So this is the same thing with investing. It's no different. You could watch TV, you could listen to friends, you could listen to family, say, hey, buy this stock, this stock's gonna go up 200, 300%. And you could just, follow them. And sometimes you might win. But in those situations where you lose, you're like, damn, what the hell happened? But you have no idea, why it went down, just like you had no idea why it went up when your friend recommended a stock. You just following other people's advice, which is it could be good sometimes if you have a real close friend or family member or advisor that you trust. But the thing that's kind of hard to keep up with that model is because whenever they buy, they have to immediately tell you when to buy. Whenever they sell, they have to immediately tell you when to sell. For example, if I bought a stock, at $10 and now it's at $20, I'm like, yeah, man, this is a great stock to invest in. I done double my money. And then you jump in at 20 and it goes back down to 15. Okay, cool. You done lost some of your money. And me, I'm still ahead because I bought at 10 and you bought at 20. Not only that, I might have sold at 20, when I doubled my money and I got out, but you had no idea, when to get out. So that's what I'm going to teach a lot of people today. So as always, if anybody have any questions, I suggest you ask. All right, cool. In that case, it is time for me to share my screen. I'm gonna share my screen real quick. If it'll come up, and you'll see exactly what I'm talking about instead of me just doing a lot of talking, which is a good thing actually. my mentor actually got me to the point where I understand how important it is for me to consistently keep talking, right? Because there's just so much information to cover. And yeah, there it goes. Introduction to the stock market. Oh man, that's gonna be cool. So before I get started, if anybody have any questions, I think it'd be a good time to ask now. If anybody got any questions, go ahead and type it in the chat. If not, we'll go ahead and get started. So as you see right there, it says introduction to the stock market, and we're going to cover some basic stuff that you should know before you start investing. So what a lot of people don't know, before you start investing, there's a few things you actually need to know. Before you open up a brokerage account, before you start buying Tesla, before you start buying Apple and all those type of things. And not like you can't open up a brokerage account and just kind of, learn along the way, but it'll be important and beneficial for you if you kind of knew some things. So as you see on my screen, four things that I kind of think you need to know, and it's a lot more. It's really the mindset of the investor. What's your mindset going into investing? Like, why are you investing? What are you hoping to achieve by investing? You know, uh, Passing the Mural test. Are you ready to invest? A lot of people think they're ready to invest, but a lot of people live paycheck to paycheck, which is one of the reasons they're trying to invest. But as you can see in a second, if you have a lot of debt and you live in paycheck to paycheck and you might need some of that money in the near future, then there might be a better way for you to get started as opposed to just jumping straight into the stock market. And then another one is, why should I invest in stocks? This is kind of go hand in hand with the first topic, but as what are you hoping to achieve by investing in stocks? You know, um, what are the pros and cons, and what are you going to get out of investing in stock? And the last one, is this a good time to invest? A lot of people really don't know when to invest. When some people, they think during a recession or depression you shouldn't invest, and actually that's one of the best times to invest if you didn't know, because stocks are at an all-time low, similar to COVID-19, what we're going through now. When COVID-19 really hit the world, I think it hit around mid-March. You could go look at the charts. Pretty much every stock out there was down, significantly 10, 20, 30, 40%, some even 100%, 60 or 70%. So that was a very good time to invest, especially some of these good companies that haven't been that low in a very long period of time. And so that's what we're going to cover. So let's get into the first topic. The first topic we're going to discuss is the mindset of an investor. This is one of the main things, is like, because it's all about your emotions, right? So as you can see, before you even decide, should you buy stocks, you have to make some basic decisions about the market beforehand. Before you even buy a stock, you really need to, make these decisions. So one is it like, how much do you trust corporate America? And you really need to make that decision because you're investing in corporate America. And if you don't trust corporate America, then maybe investing is not a good thing for you. And by when we say in corporate America, these, me personally, I invest in a lot of blue chip companies and S&P companies, S&P 500 companies. These are some of the top companies in the world. So you got to ask yourself, do I trust McDonald's? Do I trust J&J? Do I trust Amazon? Do I trust Apple? Do I trust them to put my hard-earned money that I work for, every day, to invest in a company, and that they're going to produce a return on my initial investment? Do I trust that the board of directors are going to make the right decisions for us growing the company? Because when you invest in a company, your hope is that that company profits will continuously grow over time. And as their profits and continuously grows, then their stock goes up, therefore your investment goes up. Or the more profits they earn, the more dividends that they pay, the more money you receive. That's what you're hoping for, right? And you're also hoping for, how transparent are these companies with some of their financial information that they must release to the public in the form of quarterly annual reports. Are they falsifying the numbers, which they shouldn't be because it's against the SEC? But do you trust that they're going to be transparent and provide this information? And how ethical is this company as well, right? Do they have good ethics? Do you really trust this company? So you need to make that decision ahead of time. Mm. So the next one, which is going to be covered in the third topic as well, but like, what are your expectations from investing? No, do you think you're just going to start investing today, then next week, you didn't doubled your money, tripled your money, or you're going to become a millionaire in the next month or so? Because you have to have realistic expectations. Investing is a long-term approach. Most people invest, they're thinking at least 10 years. If any stock you buy, you should look at it from a perspective of owning it for at least 10 years. Not saying that you have to, but that's the perspective you should you should look at it with. So what are your expectations from investing? And it goes into the next topic is, are you a short or long-term investor? And I get that all the time. People say, hey, teach me about investing. I want to invest. And then one of the first questions I ask you, are you short or long term? And they say, man, minority investor, I don't know. Short term is kind of what I just said. You only invested in it for the short term, a few days, a few weeks, a few months. You just want to get in, you want to get out. Or you're long term, long term, like I said, is 10, 20, 30 years. You're really looking forward to retirement, or when in your later stages in life, when you want to take it easy and when you're not as young and fruitful and, able to, work 10, 12 hours a day. Are you a long term investor? Me personally, I'm long term. And then one of the most important things, which is all about controlling your emotions. Like, how will you react to a sudden, unexpected, and severe drop in price, right? Because when people start investing, they think the market is going to go up, 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 up. The market doesn't consistently goes up. It goes up, then it goes down, it retraces, then it goes up, and it retraces, and it goes up. It doesn't continuously go up. So as long as it's going up, people are happy. Like, oh man, like it went up 1% yesterday, it went up 5%, today. Hopefully it go up 3% tomorrow. But what happens when you got 2 or 3 days, when it declines? A whole week when it declines? Are your emotions gonna get the best of you? And you're just gonna be like, you know what? This investment is not for me. You're gonna sell and you're gonna take a loss, because you lack conviction. You never really, had the mindset of, as an investor, you had the mindset of a trader. And the difference between a trader and investing investor is a trader, like I said, they're looking to buy and sell stocks, every other day, every other week, every other month. They're in and out of stocks. Where an investor, you buy one or two stocks and you just kind of hold on to it and you keep buying the same stock, sometimes, over and over repeatedly, because you're in it for the long term. And even if that stocks might go down 5 or 10%, if you truly believe in that company that you're invested in and you did your research, then over time it's going to continue to grow up. So when it declines, you look at it as like, oh wow, it's on sale. you know and then, just a few at the bottom, some misconceptions and facts about investing. Just know this. Um, Back in the day, a lot of we wasn't privy to a lot of this information that we're privy to today. But a lot of this information, like I'm a perfect example. It's here on YouTube. It's on Facebook. It's on Instagram. It's just all this information out there. Whereas back in the day, this information was kind of hard to find, to be honest with you. And so, a lot of people didn't have access to it. So a lot of people thought, investing maybe just wasn't for them. It was a skill that, as you can see, that somebody was born with, or it's hereditary. Like, oh, your father's investor, your grandfather was investor. So yeah, you're gonna be an investor. There's no way I could be an investor and be as good as you. But that is so far from the truth. Just know that no one is born an investor. I'm pretty sure Warren Buffett and Bill Gates and their kids didn't just come out knowing everything about stocks and how to invest. They just kind of learned over time. So just know that, you have just as much as advantage as just anyone else when it comes to investing. The second one is, math. People think investing is so complicated. There's all these formulas and things you have to learn, but you really don't. When it comes to, Warren Buffett and like Bill Ackman's of the world's, some of those known investors, you got to think about it. They're buying millions, millions, millions of dollars, sometimes $1 billion worth of stock. So, for them, it might get a little complicated. But for the average investor, all you need is a fourth grade education in math. All you need to know how to do is add, subtract, and divide. If you could do that, then, you'll be okay as an investor. You'll be just fine. So just know that. your math skills is not going to limit you. If you made it to fourth grade, then you'll definitely be okay. Jay, too loud. Second, or the third thing, just know, like I always said about long-term investing, that's what these next two bullet points are about. That the stock market is a device for transferring money from the impatient to the patient. You're going to hear that a lot, from the impatient to the patient. Like if you're impatient, like I said, and you're just trying to make a quick buck, quick thousand, trying to double your money, there's a good chance you're probably going to lose it, to be honest with you. If you're in this game specifically to get rich, you haven't set any goals. And if you haven't set any goals, you haven't created a strategy, you just kind of just in and out of it, and you're impatient, you're probably going to lose money. You're going to think the stock market doesn't work. You're going to tell people like, yeah, stock market is not for you. But if you're patient and you're disciplined and you take the time, then the stock market would definitely work out for you, without a doubt. I have not a doubt. I've been investing for over 4 or 5 years, and I've noticed the longer I hold a position, especially a good company that I invested in, I've never lost any money on a long-term position, long term in a good company. I have lost money short term, but long term in a good company. And when I say good company, Apple, Walmart, companies like that, it's a lot more than just those two. But I'm just naming those two, just to start off. Okay. So the next thing is called passing the Mural test. Like, what does that mean? And like, why do I have to pass this Mural test to begin investing? Well, and I kind of changed this a little bit. It said normally they recommend having a house, right? So the thinking or philosophy behind that is if you own a home, then you have a stable situation, right? You have a solid roof over your head, and you should have extra money to invest. But it's 2020. That's no longer the case. I don't own a home. I rent. I have like a 900 square feet apartment. One of the well, the main primary reason I have this apartment is it's about a half a block away from my daughter's school. And in order for her to go to that school, I had to live in this neighborhood. And when I first moved here, yeah, this was the best situation I could find. But to say that is that even though I don't have a home, I'm stable because I have this apartment. If I was to lose my job now, I have no problem paying my rent for the next 2 or 3 years. And so as long as you're stable, then more than likely you have money to invest in the market. But not only that, um, another thing with owning a home is it kind of preps you for the stock market in a way, if you think about it, because most people just don't go buy a home because somebody say, "Hey, man, I just bought this house in this neighborhood, and it's a great community, it's a good price. You should just go buy a home." And they just go and they don't do any research and they just buy the house. No, usually when you're interested in buying a house, what do? You go do your due diligence, right? You go look at the neighborhood schools, you figure out, like, you see the taxes, you go do an inspection or hire an inspector to see if there's any termites, if there's any foundation issues, if there's any faulty wires, and you go tour the house. You don't just buy the house because somebody recommended it. And you're gonna see it's the same thing when it comes to stocks. You know, even if I recommend it, no matter who recommends it, you truly shouldn't just buy the stock just because you trust them. In some cases it does work out, but you really need to do your own research. And that's one of the things why I created this channel, is to teach people how to do their own proper research, so you don't have to rely on anybody else. You can hear what they're saying, but then you could go back and do your own proper research and decide, if that's a company or a stock that you should invest in. So if you do your same diligence when you buying a house or even a car, when you buy a car, you don't just go like online and look at it and just go buy it. You go sit in it, you test drive it, you do research on it, what color you want. I'm 6'6", so I like to get in the car and see how much leg room there is, and see if my seat's gonna recline all the way back. So yeah, I do my research before I just buy a car, or the same amount of research you do when you're buying a cell phone. Same concept. And then the next 2 points. Do I need the money? And one of the reasons why, like I said earlier, if you're just investing, um, and your goal is to make short-term money, but you're living paycheck to paycheck, and there's a very strong possibility that a bill is going to be due, or you're going to need some of the money that you're investing, it might be best not to invest because most stocks are predictable, 10, 20 years, but a year or two, 2 to 3 years, sometimes it's kind of difficult. And so if you invest, let's say $1,000 and your stock goes down, 10%, and now you're at 900 and you invested that thousand, think you was going to double it real quick and you're going to pay a bill. Well, now look, you're down $100, right? And then you're probably going to sell, you lost your $100. Not only do you no longer believe in the stock market because it didn't work for you, now you're down $100 and you might not be able to pay that bill. So it might be best until you have some extra money to invest in because as you can see, only invest what you can afford to lose without that loss having an effect on your daily life in the foreseeable future. So if you need that money to pay your light bill and you invest and then you lose some of it and as a result your lights are out, that's no bueno, man. You probably want to reconsider that thought process. And then do you have the personality to succeed? So this kind of goes in hand with the first slide, but it's really important, right? How patient are you? And sometimes you just use common sense. I use common sense all the time when it comes to investing. Some things just make sense, even though you should do your research and do fundamental analysis. Sometimes you just see a company just like, yeah, just common sense why I should invest in this, right? And are you self-reliant? Are you going to depend on somebody else always to tell you when to buy or when to sell, or are you going to take the time to go and research these stocks yourself and learn how to invest yourself? So when somebody tells you something, you could go look at it yourself and be like, yeah, that makes sense. Yeah, everything's checking out. Or like, hell no, this fool leading me down a dark road. Nah, I ain't invested in that. Are you self-reliant? And that goes hand in hand with your willingness to do independent research. Even though you might be self-reliant, some people might not want to do the research. And to be honest with you, it doesn't take that long. I might spend, 10, 15 minutes a day doing research or, over the weekend, maybe set aside 30 minutes on Saturday or an hour doing research, but it really doesn't take as long as most people think that it takes to do research. So let's move on. I don't know if anybody have any questions, but we've been live for about 19 minutes, so I'll probably be live for another 11, or right around 8:30. Try to give you a 30-minute session. So another thing that you need to consider is why should I invest in stocks, right? So think about this. The first topic is one reason you should invest because your money sitting in cash will lose its value over time. And that's just a given. One of the reasons is because of inflation. As time goes along, things cost more money. Milk doesn't cost the same that it cost 10 years ago. Actually, not pretty much nothing costs the same that it cost 10 years ago. I know when I first moved to Dallas, me and my friends, yeah, we had a two-bedroom apartment. Man, it had to be about, I think it was like 1,100 square feet. Um, but all bills were paid. Electricity, water, everything was included. And I swear we were paying like $800 a month. Now for $800 a month, you could barely get a studio apartment in Dallas, So that's another reason because your cash will lose value over time. So if I would have kept that $800 that I was, a month paying for, my apartment back then, and thinking that okay, I'm gonna save it, and in the future I could use that same $800 to get a two-bedroom apartment, I'd be in a bad situation because things actually almost to the point where they went up at least 30, 40%. Uh, like I said, I'm in a two-bedroom apartment now. All utilities are not paid. Actually, no utilities are paid, and my rent is right around 1,100 a month. So tell you how inflation impacts things, or even if you just keep your money under your bed, under your mattress, it's not making any money. Another reason people invest in stocks is for long term, for retirement. A lot of people put their money in 401ks, which is good, but I don't think they take time enough to really research and see like, are they putting enough money? And when they walk away from the job, are they going to have enough money in their 401k to support them for the rest of their life? So one of the things you need to realize is, there's a rule of thumb, right? So a lot of people don't know how much money they need for retirement. A good way of looking at it is taking your current salary and I think multiply by like 25, or um, how much money you make now and then add maybe 10, 20% to adjust for inflation, over time. And that's if you want to maintain that lifestyle, then that's how much money you need each year. So let's say you retire at 60. I don't plan on dying till I'm at least 90, and I'm 42 years old now. And if I retire at 60, so I got another 30 years. Me personally, I need 100K each year of my life. So yeah, that's how much you should save for retirement. And stocks are a great way to do that. Not only do they increase in value over time, but there's this thing called dividends, which we'll cover later, which will really, really help you later on in retirement. And of course, goes hand in hand to investing to grow your money. When done right, you can grow your money anywhere from 7 to 10% per year. And you'll see probably next week's lesson, or yeah, I think it's next week or maybe 2 weeks from now. We'll cover some simple investment that annually returns a interest rate of right around 10% per year. So if you could guarantee you're going to get a 10% return on your investments every year when you do it, I'm pretty sure you will. And the last one is the most important. This is the most, look, if you don't listen to anything else, listen to this one. The power of compounding. Compounding is really the fifth wonder of the world. It is so powerful. It's so powerful that it can make you a millionaire over time. You could put, $100 in the stock market, and as you can see, if it compounds 10% annually every year, it's going to grow at a substantial rate when it gets to a certain point, way more than your bank account. It's not even close. It's not even close. And we're going to cover that in a little bit. So just know that. And the last thing we're going to cover, things you need to know before you invest. Is this a good time to invest? People ask this question all the time, man. Is this a good time to invest? And I'm going to tell you right now, anytime is the right time to invest. It doesn't matter because, as you can see here, um, professional economists and professional forecasters, they can't even predict the market. These people get paid a very large sum of money to predict whether the economy is going up or down, whether it's right time to invest. And if you go look on Google, you can look on YouTube, one economist or one analysis analyst is going to say, yeah, the market is going up. The next one going to say it's going down. And it's like that every day, every single day. So they don't know, they can't predict it. So if they can't predict it, then how can I predict it? I can't. And I don't try to. I just invest in the market because just know this, while some stocks are going down in a recession, some stocks are going up. So during this pandemic, you might have noticed that Walmart went up, Costco went up, and at one point Roku went up. But energy companies went down, like Exxon Mobil, Energy Transfer. Some of these, a lot of bank financials went down. J.P. Morgan and Chase, Bank of America, and especially airlines, they went down. American Airlines, Southwest Airlines, all of them are doing pretty bad right now. But what's doing good? Zoom is booming. Tesla's booming. Apple, Apple's booming. So when somebody tell you it's not a good time, I don't care if it's a recession, depression, and actually those are some very good times to invest. Don't listen to them. Do your own research, do your own due diligence, because as I say, some stocks are going up, some are going down, and this happens literally every single day. I day trade, so I could tell you personally, even doing Friday session when Apple and a lot of stocks went down, there were stocks that went up 20, 30, 40, 50%. They're not household name stocks, but every day these stocks go up. Just know that. And I think this is the last thing we're going to cover for today, unless anybody have any questions. But this is really important, what you should know about your bank. This is very important because when I was raised, I was just taught that, like, hey, you put your money in the bank, you work hard, you save your money, you put it in the bank. Then I don't know, 30, 40 years from now, you have this large sum of money and it'll be all good, right? That's no longer the case today. That is no longer the case. That does not apply anymore. And I challenge anybody to say that I'm wrong. You know, if I am wrong, show me, and I'll definitely change my ways. But I'm pretty sure I'm not. And you'll see right now why I say that. Because um, anybody right now, tell me what bank you bank with, and I could tell you what your interest rate is, right? So you can see right here, the average savings account pays about 0.10% average. I have Bank of America savings account. I've been with Bank of America since I was a child. I just like them. And actually, let me just click on this link because this is a clickable link. So this is one thing about my course. I put clickable links in here for everybody. So right here, okay, cool. Let's see, give this a second to come up. So if you go to bankrate.com, you can see some of the best savings account interest rate right now. You don't have to take my word for it. You can see it. And you'll see right here. Now these are all online banks, and just know that online banks pay a higher interest rates than brick and mortar banks. Why? Because they don't have the overhead. And right here, you see the highest online savings account is PNC. That's at 1%. Just know that inflation is the average inflation is 2%. So if they're paying you 1% and inflation is 2%, you can see right there you're already losing money, right? Actually, an inflation rate is 2.5%. And this is a clickable link as well. Let's see if this works. It should work. So when I bring this up, let's look at the current inflation rate. You could go here and look at it yourself. That's one thing I like about these courses that I teach. I teach you how to do your own research so that you could go look at it yourself and you can see the history of inflation. So inflation continuously goes up over time. So I don't know if that's too small. If it's too small, it looks too small. Say something. Yeah, tell me if that's better. I'll make it a little bigger for you. And you go here and you can see for your own self how inflation is actually impacting your money if you continuously trust and put your money in the bank, right? So I just gave you a great example here below. How if you put $100 in a savings account that pays 1%, after a year you have $101 in your account. But if inflation is 2%, then you would need $102 to have the same buying power that you started with. Because actually, you gain a dollar, but you lost buying power because things go up over time. And let's go to the next slide. We're going to talk about how banks leverage your money. Just know that a bank cannot be in business without you. It's impossible. Banks cannot be in business. Because think about it, banks don't have a product. They don't sell nothing, right? They just loan you money, and they need to loan you the money. Why? So they could charge you a high interest rate, right? And so I'm just gonna click on some of these links, right? And I'm gonna take you to Bank of America because that's who I deal with. And we're just gonna look at some of their rates. We're just gonna look at some of their rates. All right. Where are their rates? Gonna look at some of their rates. Oh, nope, it's the wrong link. I want to click on this link. Lo siento, my bad. All right, let's open this again. All right, here we go. There we go. And let me make this a little bigger. Start making these all 150% because that's just way too small. This is what people need to realize. Why I don't have large sums of money in my bank. I might have like $200-300, enough to pay my bills or whatever. Okay. So if you go buy a house, right, they're gonna charge you anywhere from 2.3% all the way up to 3%, right? So just look at all these mortgage rates and in a second it'll all make sense. Where is the home rates? Why is this not on one slide? My bad. Now I'm gonna do the same thing, but I'm going to show you the auto loan rates. And all this is gonna make sense in about 2 seconds, right? In about 30 seconds, not 2 seconds, my bad. So look at the auto loan. Like if you go to them right now and you apply for auto loan, they're gonna charge you what? Anywhere from 2.7% to 3.5. But if you remember in the previous slide I just showed you, if you put your money in the bank, they're only paying you an average of 0.1%. Even if you put your money in an online savings account and they paid you 1%, it's like, okay, why would you pay me 1% or 0.1%? But then the same bank that I put my money in, I come back to you and I ask you for an auto loan or a mortgage loan, you're gonna charge me triple that. Well, damn, I'm losing money by dealing with you, right? But I'm gonna show you one thing in a second that's really gonna trip you out. And the same thing goes for credit cards. Credit cards, it gets even worse, right? Because you'll see credit cards, they could charge you anywhere from 13.9% to 24%. But if they charging you 14 to 24%, that means they could pay you a higher interest rate than what they're paying you. but they're not. They're not going to pay you more interest for putting your money in the bank. They're just not. They can't afford to. Let me make that bigger. Oh, it is bigger. Can you see that? If anybody can't see it, let me know. They can afford to pay you, but they're not. And this next slide is going to show you some that change your life forever. And you should say, oh, muchas gracias, Terry. Muchas gracias for teaching me that. All right, so I'm going to show you Bank of America, the stock. So remember all those interest rates I just showed you for a mortgage loan, for an auto loan, and for a credit card. Remember how it was 2.5%, 3%? And remember what they pay you for putting your money in the bank, 0.1% up to 1%, all of that. So let's see, we have Bank of America, and let's look at JP Morgan and Chase. Okay, here's a great example, JP Morgan and Chase, because Bank of America is doing pretty bad right now. So I'm gonna scroll down here. If anybody knows what this means, tell me. If not, I'll explain it to you. You see what this is? This forward dividend yield. You see this 3.55%? Does anybody know what that means? That means you would make more money by investing in JP Morgan and Chase as opposed to putting your money in JP Morgan and Chase. Because if you remember, JP Morgan and Chase, they're the same as Bank of America or Chase Bank or Wells Fargo. They're only going to pay you max, I say, you're probably not going to get to 1%, probably by 0.1%. But if you invest in them, they're going to pay you 3.5% dividends. If you don't know what dividends is like a bonus check. Say, hey, if you invest in my company and you trust us, that we're going to pay you a portion of our profit. So we make $10 billion, we're going to, in profit, we're going to distribute some of that to our investors. So, I'm an investor, it's like I'm part owner. They're going to pay me 3.5% per year. Isn't that crazy? You can make more money investing in a company as opposed to putting your money in there. And I had Bank of America up here earlier, but Bank of America, they suspended their dividends. So let's see here. Oh, it's back. So there's this 2.8%. I can swear it says NA earlier when I looked at it, but maybe it needs to be refreshed. So let me wait until that screen is refreshed so you can see it. 2.8%. So the same thing with them. I earn 0.07%, and I have a platinum savings account in my savings account. But if I invest in Bank of America, they're gonna pay me about 500% more. Five, no, it's actually about 800% more. That's crazy. Just by shifting your money from putting it in their savings account or checking account to open up a brokerage account and investing in Bank of America. So just know that. So just know, so now you got some of the fundamentals of your mentality that you need, how to get prepared to invest in the stock market, and why you should invest in the stock market, why you shouldn't put your money in the bank, and why you should invest it. So next week, I'm going to cover how the stock market works because most people don't know what an IPO is. Most people don't know about the three major stock indexes. Most people don't know about the stock market sectors, and we're just going to cover that. So I'm just going to give you a brief view of where we're going to cover. I'm going to show you what an IPO is, and how it works. That's important for you to know what an IPO is because you're investing in some of these companies that do IPO. Then we're going to discuss the three major stock indexes. You hear this all the time. What's the S&P 500? What's the Dow Jones? What's the NASDAQ? What does all that mean? It's pretty simple once you hear it. Then I'm gonna break down the 11 market sectors. This is very important. There's actually 11 of them. And this is important because some of this may relate to your job, right? If you're in the finance, you work in a finance company, then maybe you invest in the financial sector, right? If you're in healthcare and you work at a hospital, you're a nurse, you're a doctor, maybe you invest in healthcare stocks. Same thing for real estate, utilities, energies, materials, consumer discretionary, consumer staples, all of that, right? And then I'm gonna show you, how to select a brokerage account. I'm gonna show you the pros and cons of some of my recommended brokerage accounts. Whether you should open up a regular brokerage account or RA account. And then I'm gonna teach you some basic stock terminology, terms that you hear all the time in the stock market that you like, man, I don't know what the hell they're talking about, But honestly, it's all kind of quite simple once you start learning it. Then a brief tutorial on how to actually buy a stock, how to sell a stock, and then how to build a watch list, companies that you're thinking about investing in. So I look forward to everybody joining in next week. And as always, thank you for your time. If anybody got any questions, you can always find me on my Instagram, Minority Investor. I got a private Facebook group, the Minority Investment Group. You could join that. It's all kind of information. You can always reach out, DM me, send me a message if you got any questions. But anyway, I'm gonna teach you how to invest and get you prepared. So I'm gonna stop sharing and I'm gonna end this call and thank you